Well, Eric, we've got a fun topic today.
Fun for some, I guess. If you're that close to retirement and you're starting to think about, gee, how much can I pull out?
Right, right. Well, and that's really one of the jobs that we have as financial people to help our clients know what they can spend and so that you don't feel guilty about it and you know what you're secure spending.
Right. What's the magic number? You know,
Right.
There's the old standards, and when we start talking about withdrawal rates in retirement, you know, the old standard is 4%.
Right.
And I should say that's the standard since I've been in the business.
Right.
At one point in time, I know it was 5%, but
Right.
now it's down to 4%.
And we've recently been backing it down now to what, about 3.5%.
Now the chatter is, maybe
Yeah.
3.5%.
Yeah.
Well, and there's an interesting Reuters article that kind of highlights, and in fact, they even mention in here that there's somebody that says, well, maybe 1.5% in this lower interest rate environment.
Right.
How do you pick what's that magic number so that you can make sure you don't outlive your
Well, and I think, Eric, one of the things that we want to establish is that there's probably more than two ways, but there's two kind of obvious different ways that are, let's call one the Wall Street way.
The oops method.
Yeah, the oops.
I kid, but you know, nothing better than your broker calling you up and say, oops, we ran out of money. And I'm not saying that's likely, but
right.
When you're invested
or it's dropped so much that you better back off on income for we don't know how long.
Yeah.
So
the annuity method is more of a foundational plan,
right.
And it's not to say that that's the be all and end all.
No,
but it's a great way to kind of protect the baseline of what your income is.
Right. So incorporating annuities we look at in our planning as more of a foundational part of the overall income plan. And yet, when I read this Reuters article, and I think we should spend a little more time on that and talk about it, and I think, folks, you want to look at that article and read it because it does have some enlightening aspects to it. But they're taking the Wall Street way.
Yeah.
And there's no mention at all of the possibility of using annuities for the foundational portion of your portfolio. It's all in on securities and the right mix of securities and different strategies for pulling money out.
I find there's certain things in this article that, I'll be honest, actually frustrate me a little bit.
Right.
Because when it comes to, when people read something, they tend to believe it. And because it's in print.
Right.
Yeah. There's a guy here, and I don't know, William Bengen, pioneer of safe withdrawal rate methodology. And one of the things he talks about is utilizing small cap stocks to increase returns so that you can withdraw more of your money. Now, my understanding of the market and the small cap stocks, they tend to be a little bit more volatile.
Right.
There's definitely the potential for that growth.
Right.
But there's also that potential for that drop.
So you've got a corresponding risk, and we would tend to think when a client is in that type of an investment that they're taking on more risk.
Right.
And so when I look at in all fairness, what he's suggesting in this article is that you pull back when your stocks are down, and you increase what you take out when your stocks are up. But that doesn't seem to work for our clients. I mean, as a whole, we might have a couple of clients that are in that discretionary where they could just be that flexible, but most people have a budget.
Yes, they have a minimum living standard that they have to meet their basic necessities.
Right.
And if you can't meet those basic necessities, this doesn't work.
Right.
That choice doesn't work. And so I think the best bet is truly a blending of the two methods.
Right.
Using a foundation building piece, whether it be an annuity,
right,
or Social Security, or something that guarantees that coverage across, and usually it's a combination of multiple pieces that gets you there, and then you can use a equities-based model to increase and kind of use that as a hedge for inflation, perhaps.
Right, and that would be your discretionary money. So when I look at AARP, they put some information out on this, but they also take in what I've read, they're taking more of a Wall Street methodology in terms of without looking at annuities, of saying take out a 4% rate of withdrawal. And when you start looking at that, if you're pulling that out at the wrong time, you're going to have what's called an unfavorable sequence of returns, and you can really get into trouble.
Right. And we always talked about dollar cost averaging when you're buying in.
When you're buying in,
you're more likely to hit buy in at more low times over the course of a period of time than you are high times. So it's advantageous to keep doing it in regular intervals. Well, guess what? When you start making withdrawals, the same is true. You're more likely to hit those consistent low periods.
Right.
So you're actually hurting yourself when you start pulling money out during those low periods.
Right.
So.
You have to be very, very careful. I know I've run some scenarios and some modeling of if you were pulling money out during certain years and sometimes just missing it by a couple of years. Like if you started your withdrawals back in 1975, and you were pulling out a certain amount over a certain period of time, your portfolio would tend to look pretty good over an extended period of time. But if you just started in 1973 when there was a couple of bad years unexpectedly, you would have wiped your portfolio out in a much shorter time.
Yeah, especially
cut 15, 20
on.
years off of it.
Yeah, when those unfavorable order of sequences or returns, rather,
sequence of returns, yes,
is early on in your retirement.
Right.
Those things can be devastating.
Right.
And I think what we're looking at here is as when we're saying guidance, it's take some of the guesswork out. Know that you've got a piece there that takes care of it. The standard bearers here for the market methodology, they're giving you guidance, but you have to decide if you need to be more conservative or more aggressive.
Right.
Or if you need a blend of the two to make yourself feel comfortable.
Right.
So.
Well, and Eric, when we go into annuities, it's a completely different world because we're looking at contractual guarantees. There's no market fluctuation in the income side with contractual guarantees.
Right.
So we can help a client not only know what they're going to have, but we can typically get a much higher withdrawal rate than what AARP and Reuters and certain financial advisors out there are recommending, and people are somewhat surprised by that. When we are initially show them what they can pull out of their account and pull out safely with contractual guarantees.
Right, and that's all about preserving your lifestyle, your standard of living, knowing that you're going to do it irregardless of how long you live. And I think those are the pieces that, for me, I take solace when I'm working with somebody, knowing that we've protected a lifetime of foundation.
Right.
I love working with people in the market, but we realize that there we're going after potential gains.
Yes.
We're not getting guarantees. Those are not contractual guarantees. They're
Right.
things that we're doing typically to combat inflation.
Right.
Get some of those consistent gains. And we're talking about asset allocation, not just being in the equities market. So,
Right.
So it's obviously when we see somebody advocating for small cap stocks, it gives my blood a little boiling because it's just it can be a piece of it, but you don't.
It sounds good, just to read it, but when you actually look at that and look at the the possible negative side of that, it's not very pretty. So and again, one of the things that I think that we want to stress, Eric, and just for you folks to maybe have a little better understanding of what's possible with contractual guarantees, typically when you're around 60 years old, we can get out kind of on a minimal basis for joint income for a husband and a wife, somewhere around 4.5%. And if it's a single person, maybe closer to 5%. Yeah. And then add to that, there are some ways to structure annuities so that you can actually get an inflation hedge. And if that is done properly, we've been able to show illustrations right from the company where after 20 years they'd be pulling out what, Eric?
We've actually seen withdrawals as high as 9%.
Right, in that range.
Now, obviously, caps have changed and things are a little bit more on the not quite as the participation rates and those things have pulled things back, so we don't anticipate if the things stayed where they are today, you would necessarily get that. But
it could still be up in the
7.5%,
8.5%. And so again, what we're talking about here is that you start off with, say, $500,000, and you start off by pulling out, say, 25,000 a year, and within 20 years to maybe within 30 years time, you're pulling out almost double that.
Yeah.
So instead of 25,000, you're pulling out nearly 50,000.
Each year.
Right. And so you may have used all your money.
Yeah.
You may have spent it.
It's not a plan that's designed for giving money left to the
Getting a
heirs.
lot of money back to the kids.
Right, but it's a
unless it's
plan-
the early years.
Right, but
the early years, you could die unexpectedly. The kids could get a lot of money.
Right, so it is that. But we like this a lot for hedging against inflation.
Right.
And basically taking care of your standard of living that gets those bumps each year. So.
Right, and that protects other assets if you've got that foundational income, so those assets can grow and go on to the kids.
Right.
So yeah, there's a lot of things that you can do. You don't have to look at the annuity way as the only way. You don't have to look at the Wall Street way as the only way. The best is to blend those into a very balanced allocation strategy and a balanced portfolio.
Yeah, it's all about planning.
Right.
You know, you have to plan to succeed, or what's the saying?
If you plan to, well, I can't even say it now. Plan to fail, or
Yeah,
fail to plan.
If you fail to plan, you've planned to fail, and I guess that's the summary
Yeah,
statement for today.
Yeah, yeah.